According to Forbes, Warren Buffett is worth over $130 billion. What if I told you the billionaire investor started with only $114 in his pocket? After days of diving deep into Warren Buffett's investment history, I discovered the same 7 rules he used to turn that same $114 into billions. I am about to reveal the blueprint to really getting money in the stock market the Warren Buffett way. Warren Buffett purchased his first stock in 1942. He was only 11 years old. He invested $114.75 that he had been saving since he was 6 years old from shoveling snow in the harsh winters of Nebraska. He purchased 3 shares of City Service stock at $38 per share. City Service was a natural gas company founded in 1910. Today, the company no longer exists. So, it wasn't exactly the jackpot that helped him turn his $114 into the billions he has today. It was just his first taste of the market and the start of a long investing journey. After years of his dedication to the stock market, Warren Buffett would eventually discover one of the safest places to put his money. This would have turned his $114 he had when he was 11 years old into $400,000 today.
I put that 114 into the S&P 500 at that time and reinvested the dividends. Think of a figure to what it would be worth today.
Oh man.
Well, it's
okay.
You know, but I just want your audience to think for a second.
Okay.
The answer is about $400,000.
The S&P 500 is a stock market index that measures the performance of 500 of the largest publicly traded companies in the United States. It's widely regarded as a benchmark for the overall health of the U.S. economy and the stock market.
The S&P 500 index is the one to use. That's the one I used in that bet I made for 10 years. It's the one I've told the trustee for my wife to put 90% of the funds I leave her into. The S&P 500 is, I don't know whether it's 80% of the market value of everything you can buy in this country, and it's over. I think it's over 20 trillion, and you're buying America.
Investing in the S&P 500 index fund is one of the safest and smartest choices you can make. Even Warren Buffett trusts it so much so that he put in his will to invest his wife's money in it when he's gone. The consistent returns over time speak volumes. In the last year alone, it returned 24.6%. Over the past 5 years, it averaged 15% annually, resulting in a total return of 101.5%. Over the last 10 years, it averaged 12.9% per year, giving a total return of 235.2%. This means if you had invested $1,000 10 years ago, it would be worth about $3,352 today, more than tripling your money. Although taking 10 years to accumulate $3,352 million may not seem as sexy, it's money that you didn't have to work for. It's called putting your money to work for you. The secret to accumulating more from investing in the S&P 500 is something called compound interest. I'll save that subject for a later video. The S&P 500's power lies in its diversification, spreading your investment across numerous big companies like Apple, Microsoft, and Amazon, making it a reliable and steady option for growing your wealth. Warren Buffett had figured that out. In those early days, Buffett learned that success wasn't about chasing the hottest stocks at the time or following the crowd. It was about developing a strategy based on deep understanding and solid core principles. The first 2 rules may sound a little too simple, but I'm pretty sure it's the reason why you are all here.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule.
Rule number 1, never lose money. Rule number 2, never forget rule number 1. Buffett once said, investing isn't about having a high IQ or extraordinary intelligence. It's about having a stable temperament and the ability to think independently. He then said, you need a stable personality. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd, because this is not a business where you take polls, it's a business where you think. And Ben Graham would say that you're not right or wrong because 1,000 people agree with you. And you're not right or wrong because 1,000 people disagree with you. You're right because your facts and your reasoning are right. Which means you need to be calm and steady in this game. Don't just follow what everyone else is doing. And don't try to do the opposite just to be different. Investing is about thinking for yourself. You're correct if your reasons and facts are correct, no matter what others think. The third rule Warren Buffett used on his journey into turning his $114 into billions is a lesson learned from failure. The third rule is something you should do if the facts are correct, but in this case, It was something Warren Buffett thought he was doing when he invested $14 million becoming majority owner of Berkshire Hathaway in 1965.
But buying Berkshire Hathaway itself was a mistake because Berkshire was a lousy textile business. And I bought it very cheap.
The third rule is to buy stocks below what they're worth. Buffett had believed he was buying Berkshire Hathaway below its worth, but the facts did not add up. He had begun purchasing shares of Berkshire Hathaway 3 years prior at a price of $7.50 per share. Today, Berkshire is worth over $620,000 per share. That's approximately an ROI of over 8 million %. Wouldn't you just love to have made the mistake of purchasing Berkshire Hathaway? Moreover, the fourth rule is a byproduct of the third rule. Warren Buffett thought he was buying a company at a discounted price, but in reality, he was buying a cigar butt. The fourth rule is to buy quality companies and not cigar butts.
What I call used cigar butts of stocks. And the cigar butt approach to buying stocks is that you walk down the street and you're looking around for cigar butts and you find this on the street, this terrible looking, soggy, ugly looking cigar, one puff left in it. But you pick it up and you get your one puff. Disgusting, you throw it away, but it's free. I mean, it's cheap. And then you look around for another soggy, one puff cigarette. Well, that's what I did for years. It's a mistake. Although you can make money doing it, but you can't make it with big money. It's so much easier just to buy wonderful businesses. So now I would rather buy a wonderful business at a fair price than a fair business at a wonderful price. But in those days, I was buying cheap stocks. And Berkshire was selling below its working capital per share. You got the plants for nothing, you got the machinery for nothing, you got the inventory and receivables at a discount. It was cheap, so I bought it. And 20 years later, I was still running a lousy business.
Buffett redeemed himself and finally bought a quality company. With the help of his best friend and longtime business partner, Charlie Munger, Buffett purchased See's Candy in January of 1972 for $25 million.
Yeah, well, I think there's some mythology in this idea that I've been this great enlightener of Warren Buffett. Warren hasn't needed much enlightenment, but we both kept learning all the time, so that the man we were 5 years earlier was less sensible than the man who ultimately was there. And See's Candy did teach us both a wonderful lesson. And it'll teach you a lesson if I tell you the full story. If See's Candy had asked $100,000 more, Warren and I would have walked. That's how dumb we were at that time.
10,000 more.
And one of the reasons we didn't walk is while we were making this wonderful decision, we weren't going to pay a dime more. Ira Marshall said to us, "You guys are crazy. There's some things you should pay up for. Quality, business quality, and so forth. You're underestimating quality." Well, Warren and I, instead of behaving the way they do in a lot of places, we listened to the criticism. We changed our mind. And that is a very good lesson for anyone. The ability to take criticism.
Today, See's Candies generates more than $380 million in annual sales and $80 million in profits. That's over an 8,000% return on his initial investment. Warren Buffett used the profits from those earlier investments to fund this next one in 1988 that would later make him $23 billion richer. In 1988, Buffett purchased 400 million shares of Coca-Cola. Why? Well, because it's the fifth rule of his investment strategy. Only buy stocks you understand.
Coca-Cola's been around since 1886. There's 1.8 billion, 8-ounce servings of Coca-Cola products sold every day. Now, if you take 1 penny and get 1 penny extra, that's $18 million a day. And 18 million times 365 is 7 billion, 3 less 730 billion, or $6,570 million. So annually, $6,570 million from 1 penny. Do you think Coca-Cola is worth a penny more than, Joe's Cola? I think so.
In simple terms, if the way a company earns money seems confusing or unclear, it's probably not the right investment choice. Buffett's success with Coca-Cola came from his clear understanding of Coca-Cola's business model and their value to consumers. Warren Buffett's success with Coca-Cola is a testament to his investment philosophy. Even when Coca-Cola faced challenges,
A lawsuit is accusing Coca-Cola of misleading people about the potential health risks of its sugary drinks.
Well, the Coca-Cola company is being sued for allegedly lying to the public about the effect of Coke on our health.
Well, being woke is costing Coke. Local leaders in Surrey County, North Carolina.
Coca-Cola has been accused by industry insiders of paying the NAACP and think tanks to help kill soda taxes.
Buffett remained focused on the facts. Yea, the lawsuits may have had some truth to it, but the fact is the annual revenue continued to grow year to year. Their profit margin was great, and debt continued to stay intact. On top of all of that, Coca-Cola continued to dominate the beverage industry. Knowing the facts differentiates the seasoned investor from the novice. The sixth rule is focus on the facts and not emotions. It's easy to get caught up in the roller coaster of market emotions, from the highs of a stock surge to the lows of a market crash. Many investors make the mistake of reacting impulsively to these market fluctuations, often led by fear or greed. But not Buffett. Emotional decisions in the market often lead to chasing highs due to FOMO, or the fear of missing out. It's how many investors end up buying overpriced stocks, drawn in by the hype without a factual basis. Warren Buffett's discipline ensures he doesn't buy at the peak out of excitement, nor sell in the dips out of fear. Buffett never came out and officially said this, but it was another rule I discovered from his investment history. Most of the companies Warren Buffett invested in all had one major thing in common. When you see the long list of successful businesses in his portfolio, it becomes clear that they all possess a unique characteristic that sets them apart in the market. These companies don't just rely on their products or services to attract customers, they create a lasting impression and build a loyal customer base. They have something that resonates deeply with consumers and makes them choose these brands over countless others. When you think about credit cards, the first two that come to mind are Visa and MasterCard. Warren Buffett owns shares in both. This is no coincidence. Buffett began investing in both companies in 2011, recognizing their potential early on. Both Visa and MasterCard have developed strong brands synonymous with convenience, security, and global acceptance. Whether you're traveling abroad or shopping online, their logos are marks of trust and reliability. Visa and MasterCard's branding strategies have ensured that consumers feel confident and secure using their cards for financial transactions. Through consistent and powerful marketing, these companies have built images that resonate with users, making them more than just payment methods. They are symbols of trust and efficiency in the financial world. This leads us to the seventh rule: only invest in strong branding. One stock that fits the mold of all 7 of these principles is Nvidia. Many will lose money buying Nvidia stocks because they're getting in at the wrong price. Don't buy another share of Nvidia until you watch this video. I hope this video helps you in your investing journey. Stay smart, stay informed, and keep really getting money. Really getting